Hello, Bullish Bears. This is Clint. I go by McClintock in the Swing Chat Trade Room. I've had several people ask me to make a quick video on the Darvas Box trading system, and it's a fairly simple one. I really prefer doing it now as opposed to most other forms of trading, and I'll show you the basic tenets of it. The Darvas Box method is a trend trading system. In a few words, that means you're looking for stocks in a trend, either trending up for going long or trending down if you're going to go short. And then, upon finding stocks that are trending, you use the criteria of the trading plan to determine the entry and exit points, because you just do not want to jump into the stock just because it's climbing, because that's chasing. You find the points that meet certain criteria that basically increase your chance of profit and completely lower the chance of loss. Never to zero, but as small as possible. Okay, for the Darvas Box method, you first look for stocks that have at least doubled in price over the course of 1 year. Now, you can either filter stocks where today's price is twice as high as 252 trading days ago, but in the Thinkorswim filters, I actually have them look for stocks that the 52-week high is twice as high or more than the 52-week low, simply because that's the way Nicholas Darvas did it. He only subscribed to the weekly copy of Barron's, and in that Barron's it had a list of all the stocks on the major exchanges with the 52-week low and high and the present price and the change overnight. And so I want to do everything he did exactly to try to mimic his performance, and so far I've found very, very good results. Anyhow, after you have found a stock or a set of stocks that have at least doubled in a year, then you have a few more set of criteria to meet. First of all, you want stocks in industry groups that are current and growing. In his day, he mentioned groups that would no longer be good would be like automobile stocks or railroads, because they were once growing and leading, but now they're passe. Well, today you'll want to look for, and I'll show you how, you'll want to look for stocks that are in industry groups that are growing, like cybersecurity. Another good one is aerospace defense. I'll show you the free way to do this, by the way. I subscribe to Investors Business Daily, and they enumerate the industry groups. But I'll show you how to do it with a website called FinViz. It's free. You can subscribe and get extra perks if you need, but you can use the free side of it to figure out which industry groups are leading. Of course, right here I have this example up because this is one. This is Rapid7 Incorporated. And you'll notice it's in a good uptrend. Now, what you do is you find the places where it consolidates. Now, in his day, Darvas didn't use the term consolidation and continuation patterns and so on and so forth. He noticed that the stocks that were trending steeply, they would find points where they would stop and get trapped between an upper and lower range. He called them boxes for obvious reasons. It could be a ascending triangle. It could be like one of William O'Neill's cup and handles, but it still has an upper and lower range. So he just called them boxes, so I call them boxes. Now, in this case, the stock had started to trend up. It passed its recent 52-week high, because remember, these stocks are going to new highs. You can either trade just new 52-week highs or all-time highs. Most of Darvas's trades were all-time highs, but he did say that he did a few that were just the 52-week high, and it worked, so that's basically up to you. Anyhow, this stock had risen until it broke its original 52-week high at this point, all the way across here. It climbed a couple of bars and then started to make its first box. And these boxes have he gives criteria, and I'll tell you what they are, to actually tell you what the high and the low is. But let me add, just so we can get started here, where this box is. When you see how this works, it'll make a lot more sense to you. Anyhow, it climbed until it hit a high point right here, and then it fell back. This is the first box. You still don't want to buy. What you want to do is, at that point, when it's making new highs inside of a box, start watching it and its volume. If it breaks out the top of the box in heavy volume, and if you look at this spike, that's just fabulous volume, you'll want to enter right at the top of that box. I'll give you the criteria for how far. As soon as you enter, you want to place a stop right below the top of that box, because the idea is you're riding stocks that are climbing. If the stock drops back in that same box, the trade failed and it's no good. You can re-enter it if it breaks back out, but you don't want to stay in it. You don't let it drop 7 or 8 or 10% or anything like that. You don't scale in as it falls down. You only scale in as it rises and makes new boxes. In this case, you'll notice it climbed a few bars, then immediately made another box. As long as it's climbing or staying inside of a box, you let the trade roll, because you want the profits to keep coming in. In this case, it didn't fall out the bottom. As soon as it made a new box, you would have lifted your stop loss from right here to right under this box, and then let it bounce back and forth all at once. If it falls out the bottom, it stops out, the trade's over, and you've made the profit. If, in this case, you notice in high volume, look at this bar, it broke out the top, and then it started climbing again. You notice you entered way back here. All of this now is profit. The next time it makes another box, you lift your stop loss, or in that case, you're just actually sealing your profit from the bottom of this box up to the bottom of whatever next box forms. As long as it's climbing, you don't worry about it. Now, if it falls back into the top of this box, you have the option of immediately taking profit or waiting to see if it falls out the bottom. Now, if you did scale in the top of this box, then you do want to stop out if it falls out the bottom. That's completely up to you. And like I said, I'll visit these criteria again later. That's the largest part of it. And you'll notice that if you let it just keep climbing and forming boxes and climbing, you're going to rack in quite a lot of profit. Now, industry groups. Like I said, you just don't find any stock that's doubled in price, making boxes and jump in. You want stocks that are in leading industry groups, because those are the ones that are going to help lift the stocks and continue climbing. Now, the free way of doing that, I'll show you, is with a website. Let me get through all these. We're going to come to these later. FinViz. It's free. The only thing is, of course, with free, you got to put up with pop-up ads. That can be very annoying. But I've got to let it load here. Connection's very slow today. Okay, once you get to FinViz, what you'll want to do is go to this tab called Groups and click on it. Now, what you're going to see is bar charts like this, bar graphs, and those can be annoying. So come right here and click Performance. This will actually list all the industry groups of the stocks on the major exchanges. You'll have to forgive the lag. Now, here's a list of the sectors. We're going to actually switch this to industry groups right here, industry. I promise you we're almost there. This is actually very simple. This is about as deep a research as you have to do, and it will become such a habit you won't even worry about it. You'll actually You'll probably get in the habit of checking on them once a week, maybe even printing out a list of the top groups, so you always have them handy. That way, when your filters throw at you stocks that are increasing in both price and volume and have at least doubled in 1 year, you'll then be able to check and see if they're in the correct industry group. Now, it starts off listing them alphabetically. You're going to want to sort these. Go to Performance Quarter and click on it. Now, the first sorting shows you from the bottom up. Now, that'd be good for sorting for the worst of industries, but what we want are the best of industries, so click it one more time. Now we have them sorted. This is 6 months. This is 3 months. And generally speaking, the 3-month performance, and some people will actually go by 6 months, but generally I've found that on FinViz, the 3-month performance, is the most accurate way to go. This actually shows you how well the groups are performing compared to each other. And you'll want the, of course, there's, if you scroll all the way down, you'll find there's a total of 206 industry groups on Wall Street. You're going to want to stay in about the top, say, 20%. That means Group 1 maybe all the way down to, say, 20 to 40, right around in that range. That gives you a list of the best performing groups right now. Then out of that, you'll figure out which ones are the ones that are most likely to continue growing. Like, for example, silver and copper are kind of, they tend to be a little cyclical. Even though they're performing good right now, a year or two from now, you may never know. However, if you find the groups, especially ones that are NASDAQ related, computers, software, things like that. Cybersecurity is a really good one. Processing systems and products. See, 28.13% performance over the whole quarter. That's the whole group. Semiconductor and memory chips. That's a very hot one. You'll want to find these industries, the stocks in these groups that are doubling each year, and that gives you your Darvas stocks. That gives you the stocks that you're going to be able to ride for all practical purposes for a long way with minimal headache and make quite a lot of profit. Or in the case of shorting, which that's another video. I'm not going to cover shorting on this video. This is just the long version. Anyway, that's the basics of it. I'll get rid of that. Now remember, you can come back to this video anytime you want and check that again. And at the end of the video, I'm going to put up a bullet list showing you, again, everything you want to do. I'm going to bring back that stock if I can find it. I'll show you another one. Here's a good one right now. Village Farms. Now, originally, this is an agriculture, a stock in the agriculture industry. But guess what? They just signed a deal expanding them into the pot industry. Oh, hey, look at this. Okay? It is way more than doubling, and you'll notice that once it got past its 52-week high, or basically it's close to its all-time high here, it started boxing up nicely. Here would be the first one. And you'll notice it bounced back and forth in this box. Then here come a heavy volume day, and pow, it broke out, and then it rode up. You'll want to just take all those profits. Don't cash out. You either wait for it to fall back in this box and then hit your stop loss, or wait for it to form another box. I'm clumsy at this, so you're going to just have to be patient. Here's your next box. It only stayed there for about 4 days. There's no real definition of what's too short and too long for a box. However, there are clear definitions of what makes a top and a bottom, and I'll get to that in just a second. Anyway, you'll notice, once again, here, it stayed inside this box. Here comes a heavy volume day. It pushed out the top. You could have rode that up. Now, this looks like a box, but I'll explain in a minute why it's not. Anyhow, it kept on climbing, and it has not formed another box yet. So you just Keep letting it go up and let those profits roll. The definition of a box, and this comes right from Nicholas Darvas himself, you want to find places where it hits a new high, see like the peak of this candlestick right here. Then it falls back, and 3 consecutive days, remember that, that's something you want to write down. 3 consecutive days take place where it does not break that high. Now you know where the top of the box is. Of course, the bottom is about the same. Here's the bottom. My box I drew didn't quite come all the way down. But the bottom of this candlestick did not see another low for 3 consecutive days. Magic number 3. So that defined the low of the box. If it were to have fallen out the bottom of that box, or let's say you bought here where it broke out, and it was in this box, instead of climbing up here, let's say it fell out the bottom of this box, you would have lifted your stop from here to right underneath that box, and you would have taken all that profit. However, it didn't. It kept climbing. Now that I've covered that, let's get to a few more details. How far above and below? Well, essentially, from all I've read of his books, you're looking at about, depending on if you're an aggressive or a conservative and a trader, you basically look at about a quarter to a half a percent, a 1% above. If you want to be more conservative, you can go on up to 2% above the top of the box, but you don't want to go very high because that defeats the purpose. You're trying to get as close to the top of that box as you can without getting too close to where one candlestick, breaks out of the box and then comes back in. I actually use about a 0.5% to 1% above the top of the box. Now, as far as your first stop, it should be twice as far down below the top of that box as your price above it. So, in other words, if you entered a 0.5% above the top of the box, that's above the top of that candle, remember. If you entered a 0.5% above the top of that box, your stop should be about 1% below the top of that box. And you widen both perfectly. Like, let's say you're more conservative and you went like 1 to 2% above the top of that box. Well, then your stop should be 2 to 4% below that bottom. Anyhow, then as it climbs up, when it starts making a new box, you immediately want to have lifted your stop from here to here. The stop climbs with you to lock in all the profit. You wouldn't want it to fly all the way up here and then all of a sudden drop all the way back down to this price level and you lose all that. You want to stay in the trend as long as it stays in a trend. You've heard the trend is your friend. Well, this is a perfect style of trading, and that goes with any trend trading that maximizes profit for the trend. You'll notice I didn't speak a whole lot about fundamentals. Darvas, his theory was that Wall Street's taking care of that. This stock is flying up for a reason. He doesn't care why. All he knows is it's going up. He's letting the gurus and the brokers and the analysts worry about the fundamentals. He never looked up return on equity. He never cared about earnings growth. He didn't care about debt. He didn't care about merger talks. He didn't even watch the news. There was no internet back then, by the way, anyway. All he did was find the stocks that were shooting up and found the right place to get in and the right places to get out. Anyhow, let's look at look at my bullet chart here. This is where you want to get a pencil or pen and write this down. You'll have to be patient with me. There's so much junk down here. Here we go. The Darvas checklist, I call it. This is how you first determine which stocks you want to get in on. The price has doubled or more from the 52-week low to the 52-week high. Again, if you want, you can just filter it by looking for stocks that are twice as high today as it was 1 year ago. But I prefer to do it this way. It's 6 of one and half a dozen of the other. Then you find the point in the trend that's going up where it forms a box. The top of the box will be at the 52-week high, preferably all-time high. You can do either or. I do the all-time high, but again, Darvas mentioned a few times he just did a 52-week high. It worked great. The stock is in a leading hot industry. That's about the only research you have to do. That's about the only one of 2 fundamentals he looked up. I'll tell you the other one in a minute, and it's really simple. Anyhow, it has to be in the hot industry. The 4th criteria was very important too. He wanted stocks that belonged to companies that weren't yet too big. The reason being, he figured out really fast that if a company was way too large, like today, Apple would not be a Darvas stock. Amazon would not be a Darvas stock. Berkshire Hathaway will never be a Darvas stock. The reason is, as big as they are, as large as their market cap is, it's going to be very difficult for those companies to continue to grow at 200% a year and 300% a year. You want to jump in on these trending stocks that are going to continue going up 100%, 200%, 300% until you're stopped out. And you're going to have to live a long time for some of those stocks to go that far. So, although he didn't mention the actual boundaries or limits, he did say he wanted to keep the float down and the market cap. And through looking around and doing a little research, I've pretty much ascertained that you want to look for stocks where the market cap is below 100 billion. In other words, no mega cap stocks. Absolutely none. The outstanding shares, you want to be below 100 million. And actually, most of them you're going to find as you scan and find them. They're going to be 15 million, 20 million, 30 million outstanding shares. The market cap, you're going to find most of them are going to be between 500 million and, say, 10 billion. Some of them climb up to about 20 billion, not too many of them. Anyway, just set your filters to where you're looking for a market cap of less than 100 billion and outstanding shares of less than 100 million. Now, I have a little asterisk by that, and there's a reason for it. In this day and age, you want to avoid stocks that are way too small as well, because today you have the flash boys, the day traders, and everything, which their method of making money is fine, but they tend to cause too many whipsaws if your company is too small in market cap and outstanding shares. I'll cover that in another video, but just roughly speaking, if your stocks you're finding are under $20, then you're going to want to make sure they trade at least 500,000 shares a day. If they trade way more than 500,000 shares a day, it almost doesn't matter. I found how much the stock costs. I've even found good Darvas stocks for $6 and $7 a share. They traded several million a day, and there was no problem. Again, the reason why you don't want the whipsaws, I'll tell you, if you have a stock that whipsaws too much, when it breaks out of the box, it's likely to just drop right back in because there's too much volatility. You don't want that. You don't want that headache. You're looking for ones that are going to be a little bit smoother. Okay. The other checklist, I'm going to find my right checklist. There we go. Darvas checklist. No, Darvas method. This basically enumerates the game plan. You want to make a note of this or just come back to the video as you want. The price is climbing toward the top of each box at about at least 1.5 times the average 50-day volume. It's really easy to implement these, by the way, in most platforms. I use Thinkorswim. For those of you out there using Thinkorswim, let me know, and I can show you the way I have all this coded. I've already explained the entry price. You know, you want it about 0.5% and 2% above the top of the box. It depends on if you want to be an aggressive or conservative trader. That's completely up to you. I've found that in good runs, 0.5% and even 1% is about as high as you want to go. But if you want a little bit more safety, 2%. The stop, again, is below the top of the box that you entered from. And you want to have it about a 2-to-1 ratio. It doesn't have to be exact, but that's just roughly speaking. I found in all his charts that I looked up, his stops were about twice as far below the top of the box as his entry was above it. So that's why I put that in there. I just didn't come up with that. That's pretty close to what he did. It's up to you if you want to scale in at the top of each box. That's this bullet right here. Let's say on this VFF pot stock here, which, by the way, although the agriculture industry is slow and boring, the pot stock industry isn't. When it climbed up out of here, you could either let it keep riding, in which case you would have simply lifted the stop below the bottom of this box. But if you scaled in, since you're essentially making a new position, then you have to lift your stop to below the top of this box. I hope that's not too confusing, but the idea is if you add a new position here and then it drops back, you want to minimize your loss. If you add a new position here and allow it to fall all the way back down this box before it stops out, you've taken quite a hit. The whole idea of this whole trend trading system is to ride trends as far as you can and minimize your losses, and it works very nicely. And I've already covered this one here. If the stock falls out of the bottom of the box, now Darvas went all the way down to maybe 5% down to the bottom of the box. It'll be completely up to you. Some of his were 1%, but it ranged between 1% below the bottom of the box and 5%. If it falls that far down, the trade's over. The reason being, most stocks that fall out of the bottom of their topmost boxes, it's usually lights out and game over. They usually keep falling and falling and falling and falling. You don't want that. You don't want to scale in as it falls down. You don't know how far it's going down. Again, I repeat, this method, or this trading method, is it's a stock trading method meant to ride trends as high up as they can and bag all this profit. If the trend breaks and it goes down, you don't want nothing to do with it. You want your money back, all your profits, and you go find something else that's going to make you money. You let that thing go away. I'm going to show you a few more stocks before I close this up, and I hope this didn't run too long. And I hope I didn't bore you, and I hope my Texas accent isn't hard to take. Here's a stock, RPD. Rapid 7 Incorporated. I've already showed you how this worked, but let me show you another one because I don't want to be redundant. Here's VMW. Here's a good one. You notice here was your recent high. When it went above that high, you notice it formed a box
immediately. Now this is I picked this stock for a reason. I want to show you something. Here would be the Darvas Box. Let me add a drawing. Right here. There's the box. I don't know if you noticed it, but today they would call this an ascending triangle. Here's your flat top, and right along through here would be the bottom of the triangle. This is still just considered a box. It's just a boxed in area with a defined high and low that it's bound in. It's ranged bound in this box. Now, you can look inside these and find other patterns all day long, and that's fine, but the whole idea is you're looking for horizontal lines of resistance and support, and it's right here. You'll notice it broke out the top of this box. Here was a good bit of volume right here on this candle, and it rose and rose and rose. Now, if you were to be in this one, this peaked out, and here we have another box starting right here, and it came all the way over here, all the way to this current day. You notice it broke out, although the volume really started to taper off, and it fell back down. Now, it hasn't fallen into this box far enough where a position here would have stopped out, but that's where you sit, and you don't know what the future is going to hold. That's why you simply put your stops in there. Anyway, I'll conclude with the second fundamental Darvas used. He used industry groups, and also he did pay attention to the indexes to see whether or not he should be long or short. Now, he didn't really describe. Let me find my index. He really didn't describe totally his criteria for a bear or a bull run. He did mention one time that if there's more stocks making highs than lows, then you're going up, and you should be mostly long in the market. If there's more stocks making lows than highs, then you should probably be more short than long. That's a little bit vague, and he only mentioned that once, so I don't know exactly how far you can take that. He just simply mentioned that when the market is going up, you want to have more long positions. If the market's going down, you want more short positions. This is the screen I use, and it's just a suggestion. This is a weekly chart of the NASDAQ. I chose the NASDAQ because you're going to find most Darvas stocks are on the NASDAQ. Anyway, I imposed on this weekly chart of the NASDAQ a 9-period moving average. As long as the 9-period moving average is sloping up, you're going to want to be more long than short. If it's sloping down, you're going to want to be more short than long. And you'll notice right here, this was that bear market we just came out of, okay, as of this day, as of the 23rd of March, 2019. Right here, we had a candlestick fall through the 9-period moving average. Now, remember, this is a weekly, not a daily, but a weekly chart. And this 9-period moving average very accurately told you you were going to stay in a bear market. Then we had this reversal. It was almost just a bullish reversal, and it climbed back up, and now we're back in a bullish run. Anyway, that's just my recommendation. If you don't like using the weekly chart with a 9-period moving average to tell you whether or not you should be long or short, you can look up other methods. I know some people use the 200-day average. I don't, because I think it's too clumsy, but there are a lot of traders that say if the daily charts on the indexes are above the 200-day average, you should be long. If it's below the 200-day, you should be short. But you try and use whatever system that you find most helpful. The idea here is simplicity. To me, this is simple. But again, there are other ideas out there, and you can follow those. Thank you for watching and listening. Let me pop this little thing up here. If you have any questions, this is the email that I share with the other moderators, Bullish Bears moderators at gmail.com. You can shoot them to me. I'm going to be making a few more videos to refine this a bit and show you a few hints that make it a little easier, although you'll notice there's not that many tenets to the game plan, and that's what I like about it. It's a plan with very few requirements, and it just rides trends to about their maximum limit, and you bag all that profit. It's a no pain, no strain game plan. You're not staring at screens all day. Somebody with a regular job, such as myself, can do this because you can wait until the evening and do your scans, then set your buy points when you find stocks that are boxing up at the tops of trends. It's a really good system. Anyhow, again, thank you very much, and I'll be back with you soon with another video. Again, shoot me an email if you like, or talk to me in the chat. Again, I go by McClintock in the swing trade chat. I'm in and out of it. Thank you, and have a nice day.